Welcome to the HIMS Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at HIMS, or HIMS and Hers Health, Inc. HIMS is a multi-specialty health platform that connects consumers to licensed healthcare professionals, enabling medical care for numerous conditions related to mental health, sexual health, dermatology, primary care, and more. Here's the barchart.com technical opinion rating for HIMS. The bar chart rating is an 88% buy, with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. The market is in highly overbought territory. Beware of a trend reversal. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that HIMS is well above the moving average line, so the monthly trend in HIMS is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since October, so the daily trend in HIMS is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. HIMS is below the upper Keltner channel line, so HIMS is inside the buy zone. Since the trend is up, we want to buy a call. HIMS has plenty of option chains to choose from. We're going to use the February 21 chain. Right now, the Feb 21 options have 26 days to expiration. That means any calls on the list from 21 to 30 and a half are in the money. Let's take a look at profit potential for purchasing the 31 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 31 call is 253 to 266. We try to enter near the midpoint, so we'll use 260 as the buy price. Our call option calculator shows the profit potential for this call based on HIMS price changes at option expiration from flat to a 12.5% increase in price. We can see that if HIMS is flat at 30.87 at option expiration, the 31 call will lose 100% of its value. Ouch, this is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 26 strike call to see if it qualifies for the 1% rule. Here's the calculated picture for the 26 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculated picture shows that if the HIMS stock price is up 1%, the 26 call will lose 9.1% of its value. We want that to be break even or better, so the 26 call does not meet our requirements. Let's see if that 21 call will work. The bid-ask spread for the 21 call is 10.05 to 10.20. We try to enter near the midpoint, so we use 10.10 as the buy price. The 21 strike call works. If the HIMS stock price is up 1%, the 21 call will make a 0.8% or $8 profit. That's better than break even, so the 21 call is the one we'll buy. The call option purchase calculator also shows that if the HIMS stock price increases by 2.5%, the 21 call will make a 5.4% or $54 profit. If the HIMS stock price increases by 5%, the 21 call will make a 13% or $131 profit. If the HIMS stock price increases by 7.5%, the 21 call will make a 20.6% or $209 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if a HIMS stock price does not make the expected move up and remains flat at expiration, the 21 call would only lose minus 2.3% or minus $23 compared to the minus 100% or minus $260 loss for the 31 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the HIMS Feb 21 24 strike call and sell to open the HIMS Feb 21 30 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 24 call for $720 and sell the 30 call for $310. That means the entry price or debit cost for the spread is $410. Our call option spread analysis calculator picture shows that the spread will make a 46.3% or $190 profit if the HIMS stock price declines by 2.5%, remains flat, or increases in price when the options expire. If HIMS is down 7.5% at expiration, the trade will make 11.1% or $45. Creating the debit spread will allow us to collect a $310 cash credit to our brokerage account for the sale of the 30 call. As we said on the previous slide, this reduces the cost of entering the spread to $410. Here's a note regarding earnings reports. The next HIMS earnings report is scheduled for Feb 24th. Let's review the trades one more time. The first trade was call purchase. Said to buy to open the HIMS Feb 21 strike call for $10.10. We also reviewed a spread. The spread said to buy to open the HIMS Feb 21 24 strike call and sell to open the HIMS Feb 21 30 strike call at a debit of $410. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.